Good morning, everyone. How XRP just became an institutional yield asset. The XRPL just upgraded to version 3.0 December 10th, and buried within the technical documents is a single feature that completely changes how XRP can do. It's called XRPL Lending Protocol, and it's not another DeFi clone. It's something crypto has never seen before. Protocol native, fixed rate, institutional grade lending. Let me break down why this matters. Edward Hennis, a Ripple engineer, he's laid out exactly what the XRPL lending protocol does, and he uses three specific words that I think people are glossing over: fixed term, fixed rate, and underwritten credit. Now, if you know DeFi, you know that's not how Aave works. It's not how Compound works. Those protocols use pooled collateral and variable rates that change by the block. That's fine for crypto natives, but it's terrible for institutions. Banks don't do variable rates, over collateralized loans where institution or interest rate spikes during volatility. They do fixed term loans at fixed rates with credit assessment up front. That's what underwritten means. Someone evaluated the risk before the loan happened. The XRPL just built that directly into the protocol. No smart contracts, no wrapped tokens, no third-party bridges. This is native to the XRPL at the protocol level. XRPL lending protocol isn't DeFi for XRP. It's traditional finance credit structures implemented as blockchain primitives. And that's fundamentally different design and philosophy. So here's where things get interesting and technical. Each loan on the XRPL sits in its own single asset vault. They call it an SAV. This is very critical. Each vault contains only one asset, XRP only or RLUSD only, not a mixed pool. Why this matters is because risk isolation takes place. In DeFi protocols, if one bad loan blows up, it can affect the entire liquidity pool. Lenders share the risk across all borrowers. That's pooled collateral. With single asset vaults, each loan is completely isolated. If a market maker borrows XRP and defaults, the loss stays in a specific vault. It doesn't cascade to other lenders. That's how traditional finance works. Your mortgage doesn't blow up someone else's car loan. Each vault has a pool admin, an underwriter who manages the credit facility and assesses the borrower's risk. Here's the clever part though. Third-party platforms can build user interfaces right on top of these vaults. So you get an institutional grade risk management with DeFi style composability. Single asset vaults are essentially protocol native credit facilities that segregate risk without requiring smart contracts or over collateralization. This is the bridge between TradFi credit and blockchain settlement. So, who's actually going to use this? Now, Edward Hennis lays out three specific institutional use cases, and for the first one is market makers. These are the firms that provide liquidity on exchanges. They buy when you sell and sell when you buy. Market makers need massive inventory. If you're providing liquidity for XRP pairs, you need to hold large amounts of XRP. But tying up that capital can be very expensive. So what do? They borrow. Currently, market makers borrow XRP through centralized lending desks or OTC deals with counterparty risk. Now they can borrow directly from the XRP ledger at fixed rates for fixed terms. They can also borrow RLUSD for arbitrage strategies, buying on one exchange and selling on another. This creates a predictable cost structure. And if you're a market maker, you know your borrowing costs are fixed for 30 days. You can price your spreads accordingly, and that's operational efficiency that didn't exist before. Okay, second use case. Payment service providers think about companies that process instant merchant payouts or cross-border remittances. The problem they have is liquidity timing. Let's say a merchant sells something online and wants instant payout. The payment provider needs to front that money immediately, but the actual settlement from the customer's bank, that could take days, and that's a liquidity gap. Payment providers can now borrow RLUSD from XRPL vaults to pre-fund those instant payouts. When the customer's payment settles, they repay the RLUSD loan. It's basically short duration working capital, maybe 24 to 72 hours at fixed rates. This is exactly what Ripple has been talking about for years with the XRP as bridge currency. But now there is a lending layer that makes it operationally viable at scale. Payment providers don't need to hold massive XRP or RLUSD balances. They can borrow on demand for specific settlement windows. Okay, here's the third use case. Fintech lenders, these are companies that provide short-term business loans, invoice financing, or merchant cash advances. They all have the same problem. They need access to capital relatively quickly without long bank approval processes. Traditionally, fintech lenders get warehouse lines from the banks, basically credit facilities where the bank provides capital and the fintech originates the loans. But those lines take time to set up, they have strict covenants, and they can get pulled during market stress. Now, fintech lenders can borrow RLUSD or XRP from an XRPL vault for short duration working capital, maybe 7 to 30 days. They can use that capital then to fund their lending operations, then repay when their loans get repaid. I mean, it's faster than bank lines. It's on chain, it's transparent, and it's accessible 24/7. This is where XRPL lending starts competing with traditional credit markets. And if you're a fintech that needs 5 million for 2 weeks, do you call your bank or borrow from the XRPL vault? The cost and speed comparison actually matters then. Okay, so here's the flip side that affects regular XRP holders. All those institutional use cases we just talked about, the market makers, the payment providers, the fintech lenders, they need to borrow XRP or RLUSD from somewhere. That somewhere is XRP holders lending into these vaults. Edward Hennis, he specifically said this creates a pathway for XRP holders to earn an institutional grade yield. That phrase matters. He's not saying DeFi yields, which can be 100% APY backed by essentially nothing. He's saying institutional grade, the type of yield that banks and treasuries would earn on real credit. Now, what does this actually mean? Probably mid-single digit yields, 4 to 8% annually, depending on the loan duration and the borrower quality. That's not moon returns, but it's predictable income from lending to credit assessed institutions. And here's the key difference from XRP lending. It's protocol native. You're not sending your XRP to some centralized platform or wrap it in a DeFi protocol. You're lending directly through XRPL vaults with on-chain transparency and smart contract level enforcement. Okay. Let's tackle the obvious comparison. How different is this from using Aave or Compound? Because on the surface, it sounds similar, right? You lend crypto, you earn a yield, borrowers pay the interest. But here are some of the key differences. First, Aave and Compound use pooled liquidity. All lenders deposit into one big pool. All borrowers borrow from that pool, and everyone shares the risk. XRPL uses single asset vaults, meaning isolated credit facilities with one asset per vault. Now, second, Aave and Compound use variable rates that change algorithmically based on utilization. XRPL is using fixed rate agreed upfront. And then third, Aave and Compound are over collateralized. You can't borrow $100 worth of ETH without depositing $150 worth of collateral. XRPL lending uses underwritten credit, meaning borrowers are assessed for creditworthiness instead of just being forced to over collateralize. Now, fourth, this is huge. Aave and Compound are smart contract protocols built on Ethereum. XRPL lending is a protocol native, meaning it's built at the base layer of the XRP ledger. No smart contract risk, no external dependencies, no bridges. This is a completely different design philosophy. Aave and Compound optimize for decentralization and permissionless access, but the XRPL lending is optimized for institutional credit structures and TradFi compatibility, you see. Okay, lastly, let's talk about RLUSD because this is where the whole thing starts to make sense for institutions. RLUSD is Ripple's regulated stablecoin. It hit 1.2 billion in circulation just recently, and it's pegged 1-to-1 with US dollars. The XRPL lending protocol supports both XRP and RLUSD in separate single asset vaults. And that's critical because most institutions don't want exposure to XRP volatility. They want dollar denominated assets, yes? So, a payment provider can borrow RLUSD from an XRPL vault. They can then use it for settlement, repayment in RLUSD, no crypto price risk, right? A market maker can borrow RLUSD for arbitrage strategies without worrying about XRP price swings. A fintech lender can get working capital in RLUSD and deploy it immediately. Here's where the network effect takes place. Every RLUSD transaction on the XRPL burns XRP as network fees. So as RLUSD lending volume grows, XRP becomes deflationary. It's not a staking yield, but it's still value accrual to XRP holders through supply reduction. RLUSD is currently 82% on Ethereum, I believe, and it's only 18% on the XRPL. But institutional lending might shift that balance in the future. If institutions are borrowing and lending RLUSD on the XRPL for operational purposes, liquidity eventually will migrate to where the utility is. Let's talk about the upgrade that dropped again, December 10th, because the lending protocol is just one piece. This was a major stability-focused release with fixes across consensus, networking, and accounting. Some key improvements were fixed consensus stall detection, so validators don't flag false positives during network congestion. They also fixed token escrow accounting errors, specifically when tokens with transfer fees are held in escrow, the accounting was calculating balances incorrectly, and that's critical for institutional custody. They added missing keylet fields to ledger entries. It's some technical stuff, but it basically improves data consistency and it makes it much easier to query loan positions programmatically. And they enhance security measures around peer connections and RPC behavior. So the code also includes some refactoring in preparation for the lending protocol. So this has been planned for months. The 3.0 release is an infrastructure foundation. The lending protocol amendments are also coming next. So we'll look forward to that. This was an infrastructure hardening specifically for institutional use cases. The lending protocol requires network reliability that retail DeFi doesn't necessarily care about. I hope you enjoyed this session. Take care and have an amazing day.